Welcome to IRN, and this is our video on the benefits of diversifying your investment portfolio. If you're looking to maximize your wealth and minimize risk, diversification is key. In this video, we'll explore what diversification is, why it's important, and how you can achieve it. We'll also discuss some of the potential risks and rewards of diversification and offer some tips for building a well-rounded portfolio. Part 1. What is diversification? Diversification is the practice of spreading your investments across a variety of asset classes in order to minimize risk and maximize returns. It's a simple concept, but it can be powerful in helping to protect your wealth and achieve your financial goals. There are many different ways to diversify your investment portfolio. One way is to invest in a variety of asset classes such as stocks, bonds, and cash. Each asset class has its own set of risks and rewards, and by investing in a variety of asset classes, you can reduce the overall risk of your portfolio. Another way to diversify your portfolio is to invest in a variety of industries and sectors. For example, you might invest in technology stocks, healthcare stocks, and financial stocks. This helps to spread your investments across different areas of the market and reduces the risk of your portfolio being heavily impacted by a downturn in any one particular sector. Finally, you can diversify your portfolio by investing in both domestic and international assets. This helps to spread your risk across different countries and economies, which can be especially important in times of economic uncertainty. Part 2. Why is diversification important? So, now that we've explored what diversification is, let's discuss why it's important. One reason diversification is important is that it helps to minimize risk. By spreading your investments across a variety of asset classes and industries, you can reduce the impact of any one particular investment on your overall portfolio. This means that if one of your investments underperforms, it's less likely to have a significant impact on your overall portfolio. Diversification can also help to maximize returns. By investing in a variety of assets, you have the potential to earn returns from multiple sources. This can help to smooth out the ups and downs of the market and potentially increase your overall returns. Another reason diversification is important is that it can help you to achieve your financial goals. Whether you are saving for retirement, a down payment on a home, or a child's education, having a well-diversified portfolio can help you to reach your goals faster and with less risk. Part 3. How to achieve diversification. So, now that we've discussed the importance of diversification, let's talk about how you can achieve it. One way to diversify your portfolio is through asset allocation. Asset allocation is the process of dividing your investments among different asset classes in order to achieve your desired level of risk and return. The specific asset allocation that is right for you will depend on your financial goals, risk tolerance, and other factors. To determine your asset allocation, you'll want to consider factors such as your age, investment horizon, and financial goals. For example, if you are young and have a long investment horizon, you may be able to take on more risk in exchange for the potential for higher returns. On the other hand, if you are approaching retirement and have a shorter investment horizon, you may want to focus more on preserving your wealth and may be more conservative in your asset allocation. There are a few different approaches to asset allocation, including strategic asset allocation. With this approach, you determine your asset allocation based on your financial goals and risk tolerance, and you stick with it over time. This approach can be helpful for those who are looking for a long-term investment strategy. Tactical asset allocation. With this approach, you actively adjust your asset allocation based on market conditions and other factors. This can be a more hands-on approach and may be suitable for those who are comfortable with taking a more active role in their investments. Balanced funds. Balanced funds are mutual funds or ETFs that invest in a mix of stocks, bonds, and cash. These funds offer a level of diversification and can be a good option for those who are looking for a simple and convenient way to invest. Another way to diversify your portfolio is through individual securities. This includes investing in a variety of stocks, bonds, and other securities. This can be a more hands-on approach and requires a bit more knowledge and research on your part. However, it can also be a more flexible way to diversify your portfolio and can allow you to tailor your investments to your specific financial goals and risk tolerance. Part 4. Risks and rewards of diversification. Like any investment strategy, diversification carries both risks and rewards. Some of the potential risks include market risk. The value of your investments can fluctuate based on market conditions, and there is always the potential for your investments to lose value. Currency risk. If you invest in international assets, you are exposed to currency risk. This means that the value of your investments may be affected by fluctuations in exchange rates. Interest rate risk. If you invest in bonds, you are exposed to interest rate risk. This means that the value of your bonds may decrease if interest rates rise. Despite these risks, diversification can also offer a number of potential rewards, including minimized risk. By spreading your investments across a variety of asset classes and industries, you can reduce the overall risk of your portfolio. Maximized returns. By investing in a variety of assets, you have the potential to earn returns from multiple sources. This can help to smooth out the ups and downs of the market and potentially increase your overall returns. Improved portfolio stability. A well-diversified portfolio can be more stable than one that is heavily concentrated in a single asset class or industry. This can be especially important in times of economic uncertainty or market volatility. Greater flexibility. By diversifying your portfolio, you have the flexibility to adjust your investments based on your financial goals and risk tolerance. This can help you to achieve your financial objectives more effectively. Part 5. Tips for diversifying your portfolio. If you're looking to diversify your investment portfolio, here are a few tips to keep in mind. Determine your financial goals. Before you start investing, it's important to have a clear understanding of your financial goals. This will help you to determine the appropriate asset allocation for your portfolio. Understand your risk tolerance. Different investors have different risk tolerances, and it's important to understand your own risk tolerance before you invest. This will help you to determine the appropriate level of risk for your portfolio. Seek professional advice. If you're not sure how to diversify your portfolio, it's always a good idea to seek the advice of a financial professional. They can help you to understand the risks and rewards of different investment options and assist you in developing a diversified portfolio that is right for you. Review your portfolio regularly. It's important to review your portfolio regularly to ensure that it is still aligned with your financial goals and risk tolerance. This may involve adjusting your asset allocation or making changes to your individual investments. In conclusion, diversification is an important strategy for maximizing your wealth and minimizing risk. By spreading your investments across a variety of asset classes, industries, and countries, you can reduce the overall risk of your portfolio and potentially increase your returns. By understanding the risks and rewards of diversification and seeking professional advice, you can build a well-rounded portfolio that is right for you.